Good morning, everyone. You're very welcome to this morning's webinar hosted by Bridge Enterprise Centres and in conjunction with DLR West Business Association. Today's guest speaker is Liz O'Donovan from Voltedge, who's going to talk about HR policy updates and preparing for auto-enrolment. Before Liz starts, I just want to talk briefly about DLR West Business Association, which has been recently set up to represent businesses in Nutgrove, Churchtown and Ballantyre. We're now inviting people to join. As members of the association, the fee will be €125, and that will cover up until the end of December 2026. The benefits are raise your profile through joint promotions and member showcases. You have networking opportunities, meeting your local peers, collaborating and accessing training opportunities. Gain advice through shared expertise and access to mentoring, and then we'll also advocate on your behalf for any key issues that you are facing as a business. If you scan that QR code, that will bring you directly to our website where you can sign up digitally. And with that, I'm going to hand you over to Liz. Thanks very much.
Okay, Kieran, thanks very much for the opportunity to come along today. So just a little bit about me. As Kieran saying, work with a company called Voltedge Management. What we do is we provide a wide range of HR services to both the public and private sector, to small, medium and large companies. My own background is I've worked in a number of startup companies, so I know what it's like to be in that SME side, and I've also then worked with a number of multinationals. So hopefully today we're going to touch on a few key HR topics and then predominantly focus on the topic of auto-enrolment, which is very topical at the moment. So those of you who might have joined a webinar I did earlier on in May this year will know that we touched on what was new, what was evolving in HR, what were the important things. So I'm just going to pick out a couple of things today that are still quite topical in the area of HR, just to remind you before we go into the topic of auto-enrolment. So I suppose the first most important thing at the moment is gender pay gap reporting. This applies now to companies with 50 or more employees, and companies with 50 or more employees should have the gender pay gap reporting completed by November. The government's new reporting portal is delayed, so the probably being launched on a pilot basis for about 600 companies this year, but it still doesn't mean that don't have to do auto-enrolment. Auto-enrolment still applies if you have 50 or more people, gender pay gap reporting applies if you have 50 or more people, and that in the meantime, until the portal is live, you can put the report on your own website. So then moving on, we have the EU Pay Transparency Directive coming into play next year. So that is broader than gender pay gap reporting. That is going to introduce new rights in terms of pay transparency. It means that employees have the right to know pay ranges for a job before applying. They can't be asked at interview about current pay or pay history, and they can't ask to know what comparable employees are paid on average. So these new rights will apply to all companies regardless of size. Now, there's a lot of detail to come on this yet. There's a bill currently going through the various stages in the Dáil, so it'll probably be early mid next year before we have more detail. What does it mean? It just means really that companies have to start thinking about better pay transparency, better role responsibilities and clarification to be able to justify where there's different pay ranges, being able to articulate why jobs are different. So it is going to the landscape of thinking on pay transparency, and I think we'll start a lot of conversations. So it is something to start thinking about. We also still have the retirement age legislation going through the various stages in the government's pipeline for legislation, and that again is shifting the dial in terms of when people can retire. So the new legislation will allow employees to notify their employer that they don't consent to retire at their contractual age. In the main, it will allow employees certainly to work at least until 66, which is the age for the state pension, and probably longer in some cases. So that is going to give more and more rights to employees to work longer. Then we still have a lot of talk around employment status, the definition of contractor versus employee. So this is still remaining a strong area of contention. We see a lot of issues coming up in this area. In September 25, just to flag that the Revenue Commissioners published guidance permitting employers to disclose bona fide errors in employee classification, and that would allow employers to avail of more favourable revenue settlement terms, and any disclosures must be made before the 30th of January. So just something to keep an eye on there. We're still seeing a lot of conversation coming up with that. Minimum wage, a lot of people heard in the budget, the minimum wage is going up now in the 1st of January to $14.15 an hour, and plans to introduce the living wage are on hold for now. Statutory sick pay, just to highlight that will remain at 5 days for now. We haven't seen any indication government furthering that. Just a side note there, were concerns during the year by the Medical Council regarding the use of digital certificates. I think it's been clarified that employers are obliged to accept these digitals provided they're issued by a registered medical practitioner in Ireland. So then we move on to, I suppose, topic at the moment, pension auto-enrolment. And what is pension auto-enrolment? So we're going to talk a bit more about this today and the impact. So this is the government scheme planned for workers between the age of 23 and 60, currently not part of a pension scheme. And the deadline is fast approaching. Look and discuss today what it means, the key features of auto-enrolment, what you need to do as an employer, and what are the timelines now, because the clock is ticking. And I'm sure there may be lots of questions. So what we'll do is, if you can pop any questions in the chat, and we'll allow plenty of time for Q&A at the end. So what is auto-enrolment? So there's a lot of those who keep an eye on the media. The Department of Social Protection are doing quite a number of media campaigns. So if you go on their website, they have a number of slide decks, a number of YouTube videos, there's radio bus campaign. So there is a lot of promotion being done on it. But I guess we still think that there's probably a lot of employees out there who are probably not quite aware of what's going to happen on the 1st of January. You're not already participating. So introduced. So in the first instance, auto-enrolment is being introduced because Ireland has one of the lowest levels of pension and coverage in Europe. Right now, probably about 1 in 3, or about 35% of private sector workers are contributing to a pension. And this means that, and for a lot of people, they've been relying predominantly on the state pension in retirement. People are living longer, and I guess the state pension is under financial pressure, so it's not sustainable for everybody to depend on the state pension in future. So what auto-enrolment is designed to change behaviour, I guess, by making pension saving the default. And instead of people having to opt in, they'll be automatically enrolled. And there's lots of international evidence to show that this dramatically increases long-term saving rates. Auto-enrolment has been done in the UK and Australia for a number of years. So, it's been tried and tested and proven that it does work. It does make people save more. And the goal really is to make sure that people build retirement income that supports them beyond the state pension. So how does it work and what is it? So first of all, let's look at the eligibility. So of your employee pool, who will be eligible? So it's any employee who earns more than 20,000 per year. They're aged between 23 and 60, and they're not already in a pension scheme. So it does include employees on probation, casual, seasonal or part-time contracts. And there is voluntary opt-in then for those employees who are below 23 or over 60 or outside the income threshold. So in terms of the pool, that is the pool. So who's excluded then? So those who are self-employed, not earning, or existing members of occupational pension schemes or PRSAs. And I think the government's estimation that probably brings, the latest figures I saw, I think in the budget they were looking at about 700,000 people in Ireland to come into this net. It may be slightly less than that. They think it might be 50 or 60 less than that, but we're certainly looking at over 600,000 people coming into this net from the 1st of January. So they're branding it My Future Fund. You may have seen some of the advertising out there on that. And how it's going to work is, that employees will contribute for every €3 they put in. The employer will also put in €3 and the state will top up by euro. So this means that for every €3 contributed by the employee, €7 will be put into the employee's account. And there are various percentages which we're going to look at now next. So the contribution rates are set out for the next 10 years in a scale that it will increment over the next 10 years. So year 1, to 3, which is 2026 to 2028, we're looking at 1.5% contribution by employee, 1.5% by the employer, and 0.5% by the state. It then goes up, as you can see, on a scale. And by year 10, or 2035, we're looking at 6% by the employee, 6% by the employer, and 2% by the state. And this is in line with the levels of, and actually in Australia, currently, they have gone to 12% by the employer now. UK is probably, I think it's around 8% in total, 8 to 10% in total, with at least 3% coming from the employer. I think we got that right. So it has been, launched on a sliding scale. This is the planned commitment to go forward. I think the principle is that auto-enrolment sets the floor, not the ceiling, on this. And, probably some occupational schemes, if you look at the contribution rate for many occupational schemes, employers are probably contributing a range between typically 5 to 7%. So I think that 6% is designed to land in between that. So the key features of the scheme is that, the pot follows the member. If the employee moves job, the pot stays with them. It'll be their account. It's their pension account. That's what they will have for life. The pot is invested and then it's drawn down at retirement. So that's the key features. So you will hear a lot of talk over the coming weeks about this body called NERSA. I don't know why they came up with this long-winded name. Couldn't be a little bit easier to remember. But what is NERSA? NERSA is the National Automatic Enrolment Retirement Savings Authority. And they have been set up to do the following things. So they're going to be responsible for determining the eligibility, informing the employer via payroll and collecting the contributions, facilitating opt-in and out, or a suspension via the portal, managing re-enrolment. Now, the opt-in and out will happen. So once employees are automatically enrolled, they will be able to opt out after 6 months, and then they will be automatically enrolled again at the next time. If we go back to the table, I just want to go back there quickly. So at each stage, when the percentage increases, employees will automatically be re-enrolled if they've opted out. So that's just important to note. So that will all be managed by a central authority, and they will manage then the funds that are invested. They have appointed, I think, already 3 or 4 investment funds that they will invest in. What we're still waiting for, I think, is the percentage fees or allocation rates. I think they should be confirmed very shortly. And then they're responsible for paying out retirement, managing the compliance, managing the website, the employer and the employee portal. Now, the government appointed a company called Tata to manage all of this. Tata have managed it in the UK. So, I think everybody's very hopeful that, given that they've been doing this in the UK for several years, that it will be a reasonably smooth onboarding and transition into this new scheme. So how will it work? So NERSA identifies the eligible employees. An automatic enrolment payroll notification, or AEPN, is issued via payroll. Employers get this latest AEPN, the contributions are applied, the file is returned, they're collected and they're invested. So that is the process. So the intention is that the majority of this is managed through payroll. So it really will become another function of the payroll processing team. So what does employers need to do? It does, of course, the idea is that obviously it's meant to minimize the admin for employers, but of course there will be extra responsibilities. So as employers, you have to get your AEPN, apply the AEPN and return the file, pay the employee-employer contributions, and inform the employee if enrolled for the first time. And I think this is really important because there is a lot going on in the media in terms of media campaign about it, but I still think there's an awful lot of people who are not really registering the fact that this will be coming out of their payroll on the 1st of January. So what it means for you as an employer, the aim is minimal administration for employers. Contributions will be calculated automatically by payroll software, and the National Automatic Enrolment Retirement Savings Authority will identify the eligible employees. In terms of compliance, employers will have to ensure that they're acting in accordance with the legislation. There is a resolution process being put in place for non-compliance and complaints, and there will be fines and penalties for non-compliance. So that's what it means for employers over the coming months. So planning for my future fund, I think the first and most important thing is that be aware of the increased costs that are coming. So the 1.5% of the employees who fall into that category. So budgeting for those contributions, completing the profile under the employer portal. I suppose looking at your current pension coverage. And this is where a lot of the questions that we're getting are coming from. So some of you may already have occupational schemes in place. And what does that mean? And for those of you with occupational pension schemes in place, it's looking at a couple of key things. One is, what is the eligibility period? So for example, if employees have to wait until they complete probation to join an occupational pension scheme, they will be automatically enrolled on day one, because auto-enrolment applies from day one of employment. So what does that mean? It means that companies are looking and saying, well, do I change the rules of the scheme, the current scheme, and allow everybody to join from day one? Do I run two schemes and let people go into auto-enrolment from day one, and then maybe they have the option of joining the company pension scheme at a later stage? So there are a number of things that employers need to consider if you have current pension coverage in place. So that's an important thing to do at this point, and it needs to be done, really within the next couple of weeks. Updates of payroll software. I've kind of been told that most payroll software is updated to manage this, and then really thinking about what conversations to have with your employees in terms of whether you have a current pension scheme, what's going to happen with auto-enrolment, what's going to happen if you have a scheme, they're not in the scheme, and we're certainly happy to take all those questions shortly. So looking at auto-enrolment versus company pension, and looking at some of the features. So I suppose the first thing is, both are defined contribution schemes. So there's a percentage, and that can be defined, when we say defined by the company, or in the case of the auto-enrolment, defined by the government. So the contribution rates for auto-enrolment are fixed. So you can see the increases that are planned over the next 10 years. They can be flexible, obviously, for a company or personal PRSA. There'll be 3 fund choices under auto-enrolment. Obviously, with a private scheme or company scheme, these can be flexible. One of the other key features to highlight here is that in a company or occupational scheme, there's usually a rule of the scheme that says if the employee leaves with less than 2 years service, there's a refund of contributions to the employee. If the employer contributions can come back in. Under auto-enrolment, if the employee opts out after the first 6 months, they can get a refund of their contributions, but the employer contributions and the government contribution will stay in their pot. So just that's just something to note. No AVC facility with auto-enrolment, so the employee cannot contribute more than the 1.5%, whereas you can do with an occupational scheme or a personal scheme. Now, the tax relief works somewhat differently. So in the auto-enrolment scheme, as we said at the beginning, it'll be 1.5% by the employee, 1.5% by the employer, and 0.5% by the state. So that is an effect. There will be no tax relief on the contributions, but what the government is giving is an equivalent to a 25% tax rate. However, with the company scheme and personal scheme, the tax relief is based on your tax rate. So the tax relief can be up to 40% for the case of higher earners. So that is something where we see that auto-enrolment, from a tax point of view, occupational schemes and PRSAs may be more tax beneficial for those on higher salaries. So that's something, again, that we're seeing companies looking at, particularly for those with higher earners, looking at exploring company pension schemes as an alternative. Transfers in or out, there will be the possibility of transferring previous schemes into auto-enrolment, whereas with occupational schemes that can be done. Again, no early drawdown with auto-enrolment, no late drawdown. Yes, both, there's possibility of ill health early retirement, benefits at retirement, auto-enrolment, lump sum at retirement, whereas with a company or occupational scheme, there can be a couple of different options in terms of lump sums, ARFs, and then the ability to opt out. So the government's auto-enrolment scheme, there will be the ability to opt out at prescribed times, and a company pension scheme or PRSA is much more flexible. So that's just to highlight some of the different features that are there in auto-enrolment and company pension plans. So, again, what are the pros and cons? look, for the state auto-enrolment scheme, it will definitely suit a lot of companies. It's simple to start. Employees will be automatically enrolled. The government will add a top-up contribution. The cons of that, I suppose, the higher cost contribution rates increase and they're fixed by the state, so there's no control over, what the rates will be in a few years' time. That will be set down by the government. There's limited flexibility, so there will be those three funds, again, fixed by the state. One size fits all. I guess less personal support. There will be, employees and employers will have access to the portal, but there won't be dedicated support or a provider contact. Company pension scheme, sometimes can provide more control. The refunds on the employer contributions, as I say, in that 2-year rule period, and tax relief is different. And again, the tax relief is probably more favourable under a private pension scheme for higher earners than it is for maybe lower earners. Better engagement, maybe employees have more control over their funds, get tailored guidance, attractive for talent. I think one of the things that we, have been asked about in a number of webinars is the portability and auto-enrolment, particularly for those of you who've got non-national employees. There is more flexibility with a private occupational pension scheme to transfer that to another jurisdiction. With auto-enrolment, there won't be the facility to transfer that outside of the state. So again, that might depend on your talent mix in your team. Future-proof, many company pension schemes will contribute at a higher level than the 1.5%. So, a lot of companies, if they have a pension scheme, may be contributing an employer amount between 5 and 7% already. So it might be more attractive for employees than the auto-enrolment. Setup decisions, obviously, then the cons of an occupational pension scheme, you have to choose a provider, there's initial admin, you have to manage the onboarding, and it's just a different approach in terms of admin. So what are the timelines? Because there are some urgent deadlines coming up. So NIRSA and revenue started the look back period already. So that's already underway, and there's currently testing going on with revenue data. We're still waiting for the member charges and fees to be announced. But one of the key things that's happening, and I think one of the key timelines that's being flagged to us by the brokers and that, is that really, if companies want to encourage their employees to be in their own, in a PRSA or in an occupational pension scheme, that will have to show up in the pay slip. And the key pay slip really, they're saying, is November. It may be too late by December. So if you want your employees to join an occupational pension scheme, that really, really needs to happen in November, so that it's included in November payroll, so that when revenue or NIRSA go to the look back, that it's the November pay slip, they can see there's a contribution being made, and then they're not automatically being enrolled. Obviously, the timelines here, we all know that Christmas is a lot of people take holidays, and this is happening from the 1st of January. Now, for those of you on monthly payroll at the end of January, there's a little bit of time when you come back. But if you're running weekly or bi-weekly payroll, then obviously you're straight into this in January. So you really probably want to know what's happening in December before you go on your Christmas break. So just some timelines there to be aware of. It's fast approaching. So what's the HR impact of all of this? I suppose, what we're saying to employers is, in the first instance, look at your current contracts and handbooks. What are you saying about pension? If you have an occupational scheme or PRSAs, what's happening with those? What are the eligibility timelines? What are you saying about that? So it's important to check that, there's nothing there that's going to cause an issue with auto-enrolment if your employees come into that. So payroll, obviously liaising with your payroll department, making sure that you know which of your employees are going to fall into auto-enrolment and that you've budgeted for that. So that's quite easy to do in terms of checking, look, are there any payroll pension contributions coming out already? Some employees might be contributing to a PRSA, their personal PRSA via payroll, and that will exclude them from auto-enrolment. Looking at the earnings threshold and looking at the age profile, very quickly you can see who's going to come into auto-enrolment. And then I think, looking at communication, starting to flag this with your employees to say, this is coming, this is going to happen in January, so that there's no surprises. And I suppose finally, look, think I would encourage employers to see, auto-enrolment as a positive thing, see it as part of the value proposition, see it as part of, look, this is building for the future. There will, I'm sure, be teething problems as we work through the initial couple of months. But I think overall we have to see that it's a positive thing in the long term for employees to be able to save for the longer term. So I suppose finally we come to that slide that allow time to take questions, and that's okay. Ron, maybe is there any questions or anybody wants to jump in with a question?
Yeah, just if everyone could just pop them into the chat there, I'll monitor it. Liz, that's fantastic. Thank you very much. I have a quick question for you. If you have a new employee, you said that they're automatically enrolled from day one when they start. So would your recommendation be to, if you have a company pension or company PRSA already set up, to actually put them into that as opposed to them going into the auto-enrolment?
Well, I think the most important thing is to engage with them. So obviously you can't force an employee to go into a company pension scheme or to a company PRSA, right? But I think it's about having a conversation to flag that auto-enrolment is coming, so that if they don't go into the PRSA or company pension scheme, then they will automatically be enrolled. I think there's a couple of key things why, in terms of the pension scheme or PRSA. So first of all, if the employer is contributing into it, and if it's at a higher rate than auto-enrolment, then it's worth highlighting that it's more beneficial for them. I think it depends on their earnings. If they're at a higher salary level, they may be better off in the occupational pension scheme or a PRSA, depending again on the earnings level. So I think it's really about that conversation, where do they want to be, but flagging that, they will, if they don't select an option, they will automatically be enrolled and they won't be able to opt out for 6 months, so that at least they understand that piece.
And if they do decide to not opt into the company pension scheme immediately and they fold into the pension auto-enrolment scheme, after 6 months, then they pass probation and they might decide to come into the company pension scheme then. Am I right in saying that you said that the pot can't move over from the My Future fund into the company pension scheme? Okay.
No. So what would happen then is they'd opt out of auto-enrolment or I mean, what I'm not quite sure is that, if they automatically go into a pension scheme, how does that get picked up? There may have to be, this is all assuming the system works lovely and smoothly. And what they would do is they can join the company pension scheme, of course, they come out of auto-enrolment, but their contributions, they could ask for a refund of their contributions from auto-enrolment, which will go back to the employee, but the employer contributions and the government's contribution will stay in their pot in auto-enrolment. You won't be able to transfer it across to an occupational scheme.
Yeah, because a lot of companies, I imagine, on the call today would normally implement the pension scheme once a company has passed or employee has passed probation after 6 months. So in essence, now they're incurring an additional 6 months of cost if that company were if that employee was to not pass probation and had to leave the company.
So that's the thing that we're really flagging to employers. If you have something already that's linked to probation, you really do have to look at that. No, it's not saying that you can't just, you might decide what are your options to just let auto-enrolment happen for new starters, or you might decide, again, you have to work with your broker, your pension scheme rules to check, well, what we've seen is maybe some employers saying, well, we'll just change it so you can join the company pension scheme for day one at the normal rate, or the other option is I've seen companies say you can join the occupational pension scheme from day one, but at the auto-enrolment rates, which might be lower than the pension scheme.
And some companies would historically have controls in place as well, that they would contribute to an employee's pension on the basis that they would stay for at least a year or 2 years in the company and not sort of leave straight away. Are those controls still allowed to be put in place?
I suppose, I mean, it's difficult. We would see it quite difficult to impose controls that you would stay with any employer. That would be restrictive, just because to stay for pension. We wouldn't normally recommend that in terms of, that. But I guess, a lot of companies would maybe try to say, well, look, we have the fact that, once an employee has passed 2 years, if they're in a generous pension scheme, they can keep the employer contribution. Whereas if they left less than 2 years, obviously they lose the employer contribution if they take a refund in most occupational schemes anyway. That's the way it works. So, that sort of 2 year was there, well, you couldn't force them. But yeah, so that is the challenge that we see, particularly for new starters. And I suppose, it is designed auto-enrollment for employees who move around quite a lot. They're probably with them. So I suppose that is and particularly for sectors with high turnover, it means that, the employer doesn't have to worry about it as such. You make the contribution, but the pot stays with the person, and that's the way it works throughout their career. So it's going to be very different than what we've had.
And if you're an employee that currently works sort of regular hours or doesn't quite meet that threshold at the moment, but could potentially later next year tips himself into that bracket, how can a company approach that? Is it just automatically once they hit that threshold in the payroll? Okay.
Yeah, once they hit that threshold in the payroll. And the other thing to flag is that it will be if an employee has multiple employments, the income, so supposing, they have two different employments, for €15,000 each company will contribute the 1.5% on that. So you could have an employer earning, have two separate employments.
Perfect.
But they'll meet the threshold, the total earnings threshold, to be brought into the net.
And be brought into it then. Okay.
Yeah.
I have a question in from John here. Is the 20,000 threshold applied to what the employee has earned in the previous year or will earn in the upcoming year? What happens where the employee's pay is, sorry, just a bit more here, is variable depending on the hours? Yeah, so it's kind of similar to that. So I think you've answered that there, Liz. If it exceeds 20,000 throughout the year and maybe they haven't hit that last year, then they'll automatically be brought into.
Yeah, I mean, I'm not, we'll have to see how stringent they are in terms of, and I think, because it'll be revenue based, presumably the revenue will look at on a monthly basis, as well as there's that look back period happening now in terms of coming into the net. Because obviously sometimes an employee can start during the year, for example, maybe first job they don't start till later in the year. They probably wouldn't fall in the first few months, but then the trigger probably happens when you reach a certain point.
Very good. Another question then from Karina. Hi, if the company pension scheme is based only on base pay, but the auto-enrolment looks at total gross pay in order to be compliant with the auto-enrolment rule, would we have to change the company setup and make it on total gross pay?
No, so good question. Sorry, and I should have flagged that as well, because there's lots of little things that are coming out in this. So yes, so that's another important point. So occupational schemes based on base pay typically, but with auto-enrolment, it's gross pay. So if you're paying, healthcare for somebody or car allowance, it's that gross pay in which auto-enrolment is based on, up to that ceiling of, there is a ceilings earning of, I think, isn't it 80,000. So anything up to that comes in the net of auto-enrolment. So the company pension scheme is totally flexible. So the employer can decide what's that based on. So, my assumption is that most employers will leave it on base pay. A lot of employers, particularly with high earners, would only have it on base pay and would never have included bonuses or anything. And particularly because there is a cap as well on the auto-enrolment scheme. So I don't see that they would need to change that.
Perfect. And then another one was just after 6 months, can the employee ask to be removed from all pension schemes, either auto-enrolment or company?
Yeah, they can always, the auto-enrolment after 6 months, they can opt out. The company pension scheme, they can opt out at any time unless there's a scheme rule that says otherwise. But most company pension schemes, you can opt out at any time.
And another question was then, can the employee choose between auto-enrolment or the company pension scheme? They can, once it's the choice.
They can, yeah, once the company says they're okay for them to join, that there's no waiting period, then they can, of course, choose, right? So I suppose for employers with a company pension scheme that, they might have a handful of people who haven't joined it. They can't force them into the company pension scheme. So then they're de facto in auto-enrolment. But I suppose you can try and encourage people, again, depending on their earnings, depending on, if the company pension scheme is more favorable, maybe it's a higher percentage than the 1.5% employer contribution. So yeah, they can choose, of course. Yeah.
And then from Darren, then I may have missed this, but if someone joins have they any control about where this pension is going through, what type of fund, etc., or is the state determining that? Limited control / choice, etc. Just 3 funds, isn't it?
3 funds. So yeah, so the employee, will expect to be able to go into the portal to do that, I'm expecting, but yeah,
And is there,
the detail is vague on what you get when you log into the portal just yet.
okay, and is it envisaged that the funds might expand over time? Like, what have you seen in the UK, I suppose, because it's a similar company that's running it over there, isn't it?
Yeah, they did it. I mean, the approach was slightly different in the UK, interesting enough, when they rolled it out, because what they did in the UK when they rolled it out I mean, they rolled it out over a period of, and I remember being involved a number of years ago, but they actually rolled it out so that by company size, so actually companies of less than 50 people or 10 people had about 7 or 8 years to come into the net, which was quite an interesting way of doing it as well, because it gave more time for smaller companies. I would imagine they would probably try and keep it reasonably simple and keep the fund choice, reasonably limited. That would be my expectation. But who knows, and I mean, again, in terms of the fund choice, I suppose the percentage increase, we saw government rolling back on the percentage, or the sick days, statutory sick days. Will they commit to that? We're expecting they will, but you never know. So I suppose all of these things are unknowns as we're heading into this. Yeah.
Which isn't great news for small business owners because there's lots
No,
of
it
costs
isn't.
waiting
Yeah, no, it isn't. I mean, I
in the
think we have to
wings.
assume that it will go ahead with the scale that they did. But as we saw, as I say, they did roll back on statutory sick days. So, we're anticipating they will continue with this. But yeah, it is something to bear in mind, because obviously it does go up quite considerably by 2035.
And then, is there a minimum contribution if we choose the occupational pension?
Most schemes will have a minimum contribution anyway when you set them up with a broker, but I think that you probably would have to see, if I think about it from an employee value proposition point of view, I would see that auto-enrolment is going to be the minimum standard. And if you want to encourage people in, I suppose employees will be looking either for a higher percentage contribution or the more flexibility.
Okay, very good. And then with regards to software and that, then you mentioned it's kind of all automatically done via payroll. So if any payroll administrators or accounts team that are on the call today, well, their software package that they're using, you should have an update for this coming in. Is that correct?
That's my understanding now. If there's anybody on the call that has an insight into this, it would be lovely to hear. If they've seen anything that's working, be delighted to hear it.
And then what are the key records then for just staying compliant, I suppose, Liz? Like, what should the companies definitely have on file in case?
Yeah, so I think definitely, well, I think it'll be back to the, it'll be a file that'll come, look, payroll is very automated nowadays. Everything with Ross is very automated. So, I mean, it is going to be your payroll system, your payroll files, all of those records. The payroll software will have the deduction on the pay slip. That's your record. And I would encourage all employees as well to keep their pay slips and records, because obviously, look, we really are confident and hopeful that this all works very smoothly, given that, as I say, the company involved have been involved in the UK. But look, I would always recommend, particularly for the early years, that people keep their pay slips, show that deductions have been made, show that the funds have been there and all of that. And I think it should be, I mean, if employees log into the portal, they should be able to check and make sure to check that the contributions have been made from both sides.
And John obviously mentioned there about employee variable hours and that. So should every business owner have a conversation with employees who have but could ultimately fall into that threshold next year based on requirements in the business, just to flag it with them, because it will be automatic, won't it? Like if once
yeah.
Yeah, okay.
Yeah, it's just going to hit on the, it's going to be on that earnings, and obviously again, even with the, the slight increase in the minimum wage, push people over that who are not in the net currently. So, looking at all those things and thinking about it. And again, yeah, we know some businesses do operate variable hours, but thinking what that means, or you mightn't be aware the employee has other income, that push you into that as well, because they're earning, 10k with you, but they're actually, 15k not when they fall into the okay.
I think that's all the questions we have, Liz. Is there anything else you'd like to add before we finish up?
No, just, I suppose, look, I mean, I think it's overall, to reiterate, I feel overall it's a really positive move. But obviously, notwithstanding the fact I know it's an impact, particularly on small businesses, and I think just really, really urge people to, become familiar with terminology, become familiar with the scheme, And there is a window in the next few weeks where you just need your antenna up now to pick up on the actions that you need to do. And I think, we're really trying to make sure that employees in particular are aware it's coming. As I say, government doing a lot of stuff out there, but it doesn't always, there's lots of other stuff on in social media, so it might not always be grabbing the headlines.
Very good. Well, Liz, thanks very much. Just one last slide then to show
Yeah.
people. So we have obviously upcoming events. So we have our second Tuesday, the DLR West Business Association. So the next one actually is around pension auto-enrolment as well. So that's an in-person event with Gareth Watkins from Links Financial. So you can register for those by scanning that QR code or going to dlrwba.ie. And then also we've got upcoming webinars then on October 28th and November 27th there. So you can register for those as well. I'd like to thank Liz today. Liz, that was very informative. Thank you very much. And thanks for everyone for attending the event. We'll have the webinar up online hopefully later today, so you can review it at your leisure then. Okay, thanks very much. Thanks, Liz.
Okay, thanks, Kieran. Bye. Bye-bye.